structure of XAUUSD on a monthly time frame. On a monthly time frame, we like to look at the structure starting from the history of gold. So we're looking at almost 100-year life cycle of gold. So we are going to look at it from 1883. Way back 1883, gold per ounce was $20.36 per ounce into 1931, and the major deal for it starts around 1933, and price now climbed up. If you look at that structure, you will see something that the the structure of gold starting from 1933, price rose, and from 1933 we moved to continue moving at that rate at $34 per ounce until we got into 1944. So I'm more interested in the history that happened from 1944. You see, when the dollar stopped being pegged by gold, a lot of things happened before that. If you look at the structure from here, the Bretton Woods system agreed in 1944, pegged major currencies to the US dollar, and the dollar was convertible into gold at a fixed $35 per ounce. And you have seen a flat rate running from 1934, price running parallel horizontal structure into 1945, 1944, 1955, 1957, 1961, 1963, and 1967 up till 1970. Now I'm going to stop there to make some brief explanation and to put it into context. You see, when the Bretton Woods agreed in 1944 to peg major currencies to US dollar, and the dollar was convertible into gold at a fixed $35 per ounce for foreign governments and central banks, you will see that that held for a very long time. But something tragic happened. There was an end to that, which we call the Nixon Shock on August 15, 1971. You can see it from here, 1971. President Richard Nixon suspended the convertibility of dollar into gold and closed the gold window standard era. The official holders could no longer exchange dollar for US gold reserve. This marked the end of the gold standard and start of a modern fiat currency system where dollar was now backed by trust instead of being backed by gold. So it's a smart move. The Federal Reserve System used over 30, 40 years to accumulate gold, and it was more like tricking the entire world. And by 1971, President Richard Nixon suspended all. So you could no longer swap gold with a US dollar. Keep your dollar, the gold remains. This marked an effective end of the gold standard and started a modern fiat system that made the United States dollar to be backed by trust. And you can see from 1973, it was like when somebody is being released from cage, gold was now released from cage and the price now begin to rise. So floating it in the market. So you see, gold price has been suppressed for more than 50 years. They suppressed the price for more than 50 years. This is a period of accumulation for Federal Reserve. So after the 1971 Nixon shock, you see the price was now let open and the market floats, and you can see that the price of gold was now exposed. Now it is normal, and that is how life is. There's always going to be someone smarter than you in everything you do, so you have to take it. So you see, by late 1960, 1980, the gold started building pressure, and the Bretton Woods strained the whole thing. Official price has been 35 for a very long time, and you can see price peaked after the Bretton Woods agreement by President Richard Nixon. You see price have rose sharply. The rise in gold rose to the point that by 1978 into 1980, price has already formed a double top, and the market touching 871 871, 866 from 1970, 1971, end of Bretton Woods Agreement. Dollar was released and the real value, rose in a short period of time. And you see, price have formed a double top and now enter consolidation. Normal after a rally, market going to consolidation. The rally started after the end of Bretton Woods. Price rose sharply, and the dollar, gold price, hit an all-time high, 866 by 1980, 10 years after. That's a decade after the end of the Bretton Woods by the President Richard Nixon. So you can see that the whole thing was manipulated, and it was more like the entire world banking system, central banks being tricked. So it is what it is. So market went into consolidation, and after that period of consolidation in 2001, market peaked again. You know, it peaked again, and we continue to see it. And by 2001, you can see a major reaction at this area. That's another strong bull market time when market picked up from here. The market didn't just pick on its own. There are so many factors surrounding that. There's a post.com recovery, emergency market, and a whole lot of things. And we're just coming up. And from there, we move into 2008 global financial system breakdown, and the market continue to rally there. So that's what we have for there. And it's been an amazing time to see the history of gold and how price rose. And the most important time is the 2008 2009 financial crisis. And you can see how the 2008 2009 reacted, and price moved from there. We moved quickly as fast as possible. And you see when price returned back after that rally from 2001, market rose into 2012, another decade again, 10 years. The good rise, bull market is every 10 years. You see an explosion, consolidation, explosion, consolidation, explosion, consolidation. It happened after the end of Bretton Woods. We see price rise, and by 1978, 1980, you see price move into consolidation to regain from the bullish rally. And we started again from 2001, and we move into the dot-com era. 2011, 2008 financial crisis, we stormed it all. And by 2011, price went into consolidation again. And by 2019, another wave regain. And you can see how price moved. By 2026, market is going into consolidation. The commitment of trade of gold shows that net commercials are going short. It is very normal. If you see everything that happened after every decade, consolidation, market short. After every rally, market short, consolidation, market rally, short, consolidation before you see a swing. I think gold price will drop very well. Where I see a very strong potential for upswing. If you are someone who wants to accumulate gold, you have to allow price to return into 3,265.92. It is where I see a meaningful demand. This is where I see a strong demand, to continue that rally. And the best among them, if you really want to get into the structure very well, is around 2006-12. And if you look at what price did here, when price hit in 1978, we touched 863. The price actually dropped. It dipped up to 256.245 dollar. I mean, this is what happened starting from 1980 to 2001. And the drop we have now, it's not even compared to what we had in 1979, 1980, good drop and consolidation era before the dot-com bubble and global financial system rise. So I think technically the market has to adjust itself. And the key thing here to note is China perspective on paper gold and physical gold. The People Bank of China and major state banks has been consistent with a physical gold buying, and their gold reserve has risen largely, into 2026, then becoming one of the largest stockers. And the major Chinese banks led by ICBC, the world largest bank by assets, plus Postal Service Bank and Gongfu and others are ending retail paper trading So they are ending it for real. They want to end it. They are ending retail paper slash leverage gold trading linked to Shanghai Gold Exchange, and the date they ended it was July 24th, few days ago. So clients were now told to close positions, liquidate, or take physical good delivery. It's something coming in. It's something coming in. They have not banned the ownership of gold, of physical gold, jewelries, accumulation plans, and gold ETFs. No, those ones remain, functionally available. And but the most important thing is paper gold leveraging has stopped. So, and when ICBC leads such move, ICBC is also responsible and answerable to People Liberation Army, the top organ brass, that control all Chinese leadership. So it's more like an internal home agreement, and the idea is broader than we think. It's broader than we think. So all speculative paper trading has been restricted for all retail traders. So physical ownership is okay, you know, it's very, very open. That paper trading, no, no more. So they want to see physical gold. They want to see physical gold. And lately, China has also expanded physical settlement infrastructure in Hong Kong, for clearing and building a massive vault. The amount of vault they are building in Hong Kong, it runs and can accommodate tons and tons and tons and tons of gold. So no matter the quantity that comes in, of course, we all know that Hong Kong is becoming a global financial center, defeating Switzerland and Singapore. And it makes the market open to West Asia and other areas of the world. So Hong Kong technically is becoming the biggest clearinghouse. And I'll tell you for free, the influence of the Western paper dominated by Kumis has failed and lost its grip. So let's see how it unfolds as time goes on. And the fundamental is more important than whatever we are doing. It's important to understand it. And the question now is, what does this mean for the future direction of gold? The long-term direction is that gold price will be revaluated, and you see gold per ounce hitting about 10,000 per ounce. This is going to happen because the structural preference in China for physical gold over leveraged paper, it cannot be negotiated. So the ongoing geopolitical and monetary uncertainty surrounding it has really taught the Chinese bank a lot of lessons, and they now request for physical gold. That is something to watch. That is something to watch. That's something to watch very well. So we must look at it and see that the game has changed. So we might most likely see revaluation of gold, and you see price begin to rise. So let's look at it by structure. The structure gives us a clear overview into the direction of the market. So we have seen a brief history of the market in the last 100 years, and you see why gold remains the new money after basically tier one recognition of gold as a strong liquidity asset for banks. So we can see here from the monthly time frame, which is my preferred chart time. If you look at here, you switch on to your line chart to catch the prospect of the market. You will see that price has created a very strong price action here at this level, and we have seen how it played. You see price formed here a double top structure in 1980. In 1980, 1979, price formed a double top structure, break of the neckline of the double structure, and a return here, a clear break and retest, break of structure followed by a retest, and you have seen a bearish drop. And that price action has been respected. And you see when price returned back in 1982, it respected the neckline of the double top that was broken in 1979, 1980, and price dropped. And when price returned in 2011, after the Great Depression area and the global financial system breakdown, price returned there and still respected it, and we start to drop, followed by consolidation, followed by a new rally, and price went parabolic. And into 2026, we have seen a strong uprising in the price of the yellow metal. So this is what we have, and the market is well calibrated. And if you place this structure, clone it, you see the market makers already knew where the market would buy, and you see they sold exactly where the 2009, I'm sorry, the 1980, 1979 rejection at that trend angle. So this becomes a valid trend angle in the future. So when we are talking about a meaningful demand for good, there is why institutions are shorting good. They are shorting good for accumulation and to correct the market. After a rally, market go into sell. After sell, market go into consolidation. Market picks up again. And yes, the market have initiated the first leg of sell, but it has to go through consolidation. After the consolidation, then you now see rally again. We have seen it before. The end of the Bretton Woods by Richard Nixon. We have seen what happened when the gold price was let out from the cage. After 40 years of accumulation by Federal Reserve, we have seen an explosive price from 1970. Price rose from $36, $35 per ounce. In a 10-year time, you see price moved into 886. So you can see what the Federal Reserve have done to the entire global financial system. They held them firmly from 1937 into 1970, accumulating gold, promising them that they could swap their dollar for gold. And all of a sudden, Richard Nixon stopped it. And after that, we have seen a sharp rise in the price of gold. That is the real valuation now came into light. And after that, we saw a drop followed by a consolidation. Then we saw another rise in 2011. A market move from 2000 and from 2011, 2001, we saw a push and we got into 2000. Another 10 years, we had a drop, went into consolidation and moved up again. So it's a little bit technical and a little bit technical, a little bit technical. Now, if you look at what happened on that double top structure, if you place your monthly chart on that resistance structure, you will see that the market is calibrated. This is pure mathematics. We had here a double top, the head of the double top on a monthly time frame, and when price returned in 2006, it respected that double top head. We tested it, we broke the structure and came back here on retest. A broken supply roof becomes a demand floor and a foundation for uptick. And you have seen a new rally continues again. And from 2008, during financial crisis, we have seen that the market lost their confidence in paper fiat money, and gold became a safe haven during the crisis era. And price pushed into 2011, where it aligned with the neckline of the double top structure, and you have seen price have dropped from there. Look at it on your line chart. You will see a double top structure break of a neckline, and price came here to retest it. So this is what we have, and we got that structure broken in 2025, and price came back on retest, and we have seen an explosive move in price of the yellow metal. If you clone that structure and you place it in 2000, in 1978, 1980 all-time high, you see that it aligned with the current rejection in 2026. That tells you that the market is calibrated. It's pure calibration. So you see, we expect that after that drop, market should drop significantly, then go into consolidation, then before the next rally again. So it could most likely that after the drop consolidation, in the next 10 years, the price of gold will double again. We have seen it before. In fact, we have seen it before from the end of the Bretton Woods, price rose from $35 in 10 years time from 1970 to 1980. We see price rise into 800 and look at it, 899, 25 times X, more than 25 times price rose. So it could happen again. And I'll tell you, the price of gold is going to be reevaluated. And it has been on the way. And the People Bank of China are doing that to ramp up that plan. So what I see technically is that we should come down, dip ourselves into around 3,245, maybe consolidate, then we start up from there. So at the moment, institutions from the Kumis data we have and from commitment of trade for gold says that there is a net short from commercials, and when commercials are shorting, they are shorting to hedge. So there's a reason commercials are shorting, so align with the commercial shorts. Of course, retail traders can never defeat them, so let's see what they do. If price pulls into there, that will be a good time to see that price has moved from there. And if you look at the structure from here, you see after that breakout price of leverage here, and you see that we picked up from 2022 a